Good morning, Brian. How are you?
I am well, Ryan. Good morning to you. How are you doing?
I'm doing good. And as we were just saying, you're definitely more well because you're in Marco Island and I'm in Minnesota. So we can just leave it at that. And I'll just even restate that after my dad and I sold our company, he literally was like, I don't think you could get the burner phone and on that plane to Marco Island as fast as he possibly could. So I've never been, but I can only, I know it's a little bit different than here. Anyways, I digress.
Yeah, you could say that.
I'm very excited to have you on the show. I've had your brother on the show, and ITR is just a company. What you guys have built is just very impressive, and it's got a very, very good name in the CEO peer groups that I participate in as well as yourself. So why don't you just give everybody that has not maybe tune into those other episodes a little background of ITR, your background, and then we're going to set some of the foundation of kind of your rates of change and the business cycles that you guys kind of have a framework on. And then we'll kind of get into some of the data and some of the economic information that you can provide. And then we'll kind of tee it up for the future quarters.
Sure. Sounds great. What I think separates ITR Economics from so many other places is we have a unique methodology that produces superior forecast results, forecast accuracy. And I've never come across anybody else that's willing to show their forecast accuracy year after year, pandemic, no pandemic. Every year we'll show you how we got right. We'll show you what we got wrong. Complete transparency in that regard. And that engenders trust, right, with clients or people who are listening to us from the stage. The other aspect and there are two more that make us different, is we are totally independent. I don't get paid any more or less. Nobody on my team does, whether we are seeing a recession coming or a nice cyclical rising trend coming. We get paid for giving you the reality as we see it, as far out as we can see it. In a lot of companies, they don't have that luxury. Internal economists, they don't have that luxury.
I would say a lot of people don't have that autonomy, Brian, these days.
Yeah, that's true. I remember one time, if you don't mind a quick anecdote, Alan was talking to a particular client out in California. They were owned by an overseas concern. And Alan was talking to the board, local board, the U.S. board, and saying, expect a 10% decline next year. And they said, no, stop. They will not accept a 10% decline back to the home office. You cannot say that. And they were recording this. So Alan said, well, turn the recording back on. Alan said, you're probably going to be about 10% up next year, but I think I'm going to be off by 20 percentage points.
Yeah, I love the delivery of that. That's fantastic. But when I came across you guys, when Alan was the first on the show, Brian, and he was explaining kind of your guys' forecasting. I mean, why is it so unique that people don't publish their results?
I think for them, it's because they change them all the time. Our major competitors, the big houses, every month they have a new forecast. So I guess they just don't want to go back and let people know how they've done, because maybe they haven't done so well. I mean, that's the implication that we get anyways. But we tell every audience, every analyst has a bias, and our bias is we're capitalists. And our bias is you need to know what we can do, and we'll tell you what we can't do. Ryan, ITR Economics, we won't work for governments, because that's the third leg of what makes us different, is we are independent. I don't want to be beholden to Republicans, Democrats, any administration, local, national. Just not our gig. And we also know that there are parts of the private economy that we're just not terribly good at. So we don't go looking for work in those areas. And if somebody comes to us and says, well, we really, really want you to do this, guys, we'll say, okay, but you need to understand that 12 months is as far out as we're going to go, and our forecast accuracy is going to drop from 95% down to 85% because we've run those numbers. And if you can accept that, all right, then we'll do it for you. But we're not going to snow you into thinking that we can really do a great job or a normal job on this sort of forecast. And our clients over the years have really appreciated those three things about us. What I learned, you mentioned Vistage, a long time ago through Vistage, when I was on that speaking circuit with Vistage, I learned a long time ago, always hire people who are smarter than yourself. And, when you're young and you own your own company, that's not always that easy to do. But I took that to heart. And every hire we make is they got to be smarter than me, and they got to be smarter than the person that just left.
I love it.
Now, Alan, you mentioned my brother Alan. He says, in my case, that wasn't so hard to do, to find people that were smarter than me. But,
that's awesome.
But I still
great.
follow the advice, is the point. And today, every year, I'm so proud of our team. There are over 70 of us now at ITR. Half of them are economists, and we're analyzing more data, more globally than ever before, and we continue to keep our forecast accuracy up there. We know how to train people in our methodology. Rate of change is simply a tool within that methodology. And it's been a great ride, Brian.
We
we know, because people tell us that they say, guys, do you realize that and I remember this so clearly, I was 6 months away from closing my business. It just wasn't worth it anymore. But then you told me that if I just hung on, a year from now, I'd be back to where I was. And he goes, 600 people did not lose their jobs because what you guys told me. And I tell you what, when somebody gives you a story like that, it just keeps you going for the next time.
Yeah, you have no choice but to keep going, right? I mean, you're providing that much value to the world with that. And seriously, I mean, I'm again, it's another reason I'm so grateful for your guys' and agreeing to this, because of how, like, the three legs of the stool you just talked about, the independence and your guys' ability to publish it. Everything that you just mentioned is why I'm excited, because I think there's such a thirst for privately held business owners, Brian, to get this information that's not Jamie Dimon on Squawk Box, that has nothing to do with them. You know what I mean? It's like, okay, like, no, I'm just trying to make ends meet. I'm trying to hire the next person, trying to figure out where they're coming from. Where's the supply chain at? The very real information that I'm just very excited to dive into. And you had alluded to, Brian, your guys' methodology and the rates of change. So, given the fact that we're going to have this on a more regular basis and cadence, well, it's kind of like set the foundation of, like, what is the methodology? What are the important concepts we need to understand before jumping into a bunch of the granular numbers?
Well, do you want to talk about rate of change first as the tool within the methodology?
Yeah, let's do it.
Rate of change, and we used to call it pressure curves back in the old days, is simply looking at the latest aggregation of data. That could be 1 month, could be 3 months, could be 12 months, and comparing it to the same aggregation 1 year earlier. And what that does is it takes all seasonality out of the numbers, and you start looking at cyclicality when you do that. And it's predicated on the reality that trends don't change direction on a dime. The slope of the actual data will begin to bend one way or the other, all else being equal. And it's that slope that you can most easily measure with rate of change. And we've been in business since 1948. In all those years, it is in that rate of change where we have found the regularity that we can measure. How long the cycle tends to last. We can measure things like what's the slope on the downside going to look like based on the magnitude of rise on the upside, or how high the year-over-year growth peak was. What does that tell us about what the cycle is going to look like on the downside, or even on the upside? And that isn't possible when all you're doing is looking at the data instead of the rate of change. And we also use rate of change, and this gets a little too nerdy, so you may want to edit it.
No such thing. Come on, Brian.
We use rate of change, and it's called the L2 concept. If you want to see the business cycle, you use the 12/12 rate of change. But if you want to see a longer-term cycle, some people call it a Kuznets cycle, Schumpeter type cycle, then use a different rate of change. If you want to see what's going on over the course of an inflation cycle, like we forecasted the disinflation period of the 80s, 90s, and 2000, not based on 12/12 rate of change, but based on a much longer harmonic of the rate of change. So you got to change the rate, the tool, calibrate it differently depending on the cycle that you wish to see. And it's one of those things that used to be described as, you're not going to believe how easy this is, how simple it is to employ this tool. And it's true, the tool is fairly simple. The process gets more difficult when you need to be objective, and when you don't have a dog in the fight in terms of whether it's going up or down. That's just the reality. There is no good or bad in economics. It's just the reality of what's going on. So we use this rate of change tool the way someone would use a screwdriver or a wrench, but we use it across platforms. The forecasting methodology itself starts with our unique business cycle theories, and they are unique. I was taught them back in the early 1980s, and with the advancement in computer science, data science, I've been able to refine some of those aspects of the theory, hone our craft a little bit better, but it's essentially the same approach
structure.
Yeah. Our founder, Chapin Hoskins, was taken back in the 30s, really, when he first started doing his research. And so we have our foundation based on business cycle theory. Then we look at what's going on today in the subject data series. Could be a company, could be aircraft manufacturing. What do those trends look like? What is that trend telling us? How does this stack up to prior cycles based on the extant variables in the economy today? And then not most importantly, but as a very good short-term tool, what are the leading indicators telling us? If it moves, we'll find a leading indicator for it. And if there isn't one, we create one. Because that leading indicator gets you into a level of objectivity over the next 6 to 12 months that you wouldn't ordinarily have. And it doesn't rely on what the Fed says. It doesn't rely on what the administration says they're going to do. We just look at the leading indicator.
Doesn't matter if Jamie Dimon changes his tune between 1 week and the next, and what do you think is going to happen? Well, and it doesn't matter when our clients will say to us, hey, consumer expectations are down. What do you think that's going to do? That's going to create a retail sales. And we say, no, put a pause on that. We've looked at this countless times over the years. Consumers are responding to those surveys based on what was on the news cycle the prior couple of days. It has nothing to do with how they are going to behave tomorrow. If they have money in their pocket and they have a job, they can be depressed, pessimistic, say anything they want. But they're going shopping because that's what we do. And as long as might not be with a smile on it, but they're going shopping.
Yeah, they're going shopping. So as long as they keep shopping, we're fine.
It's super fascinating, Brian, because I think about years ago when I got introduced to your guys' organization and your guys' material compared to now. I mean, I've learned and grown a lot too. And one of the offerings that we have from our business is fractional CFO services. And my business partner, who was in private equity and was a CFO for years, and still is. But what he takes, Brian, and it came through the years of doing that, and in the Excel models that he built, is trailing 12 months of the income statement. But each month is a trailing 12 month. So essentially you can extrapolate similar to that, what you're talking about, the rates of change. It's not even close to what you guys are doing. But my point is for the listeners and to kind of highlight what you're talking about is it's where the picture arises, right? So I watch people that are visionaries like me, entrepreneurs that are going, yeah, I'm kind of following what you're saying. Lots of numbers, lots of spreadsheets. And all of a sudden, boom, they see this picture of what's happening with the changes in their income statement. This is something they all understand the story. And there was this one gal, Brian, she said, I finally can see what I've been feeling for years. So I just wanted to highlight. Isn't that cool? Right? Isn't that cool? I know.
Yeah. That is fantastic. And it all starts, by the way, with the trailing 12. That's what we run the rates of change off of. That's how you run the 12 over 12 rate of change, is off that trailing 12. So that is cool. When people... I'm finally seeing what I've been feeling all these years. That is really cool.
So we want to give us a little bit more context behind your guys' business cycle theory, because I think as we continue these conversations, we'll want to kind of layer them into the rates of change and kind of what's going on in the business cycle, because there's a lot of, like you said, consumer sentiment, we got supply chain issues, interest rate, all those different data points, another reason I'm so excited to be talking to you guys is that you guys bring context to that information. And I don't like information without context. That's just a fault of mine from years of being in the school system. It's so give me the context and then we can put the little pieces inside of it. So what kind of give us an overview of the business cycles?
Voltaire once said history never repeats itself, but man always repeats himself. So the cause of business cycles from one cycle to the next is so variable. But what isn't variable is how people tend to respond to the stimuli that is the business cycle. And I think that's an important separation you have to make. The cycle is here maybe for a totally new reason. We haven't seen this reason before, but how people are going to respond to the circumstances, that we know, that we've seen before. And when you can start modeling that, then you can understand the business cycle in a different way. The other thing about the business cycles from our perspective is there are corrections. Just like in the stock market, it goes too high because there's exuberance. And then something happens and it starts coming down and people get afraid and they're selling, and most of them will sell at the very bottom of the stock market. Most people in business, if they don't know the context, which is why I love that word you just used, they won't know that at the bottom of the business cycle is the best time to make their move. That's the time when pricing is going to be most advantageous, when interest rates are going to be most advantageous. If you can step out while your competitors are still timid, you've just taken some market share, you've a quantum leap ahead of your competitors because you could see that the reversal was at hand in the marketplace and in your business. But I tell you what, it's not, we can present it, but there's the fear factor. And oftentimes somebody has to live through seeing it at least once before they get the understanding. Okay, next time I'm going to be ready.
Well, and you said fear factor too. And I think, Brian, a lot of the fear comes from no context of the trends that are happening, because every entrepreneur that I've ever met, Brian, self included, is calculated bets. And as you get older and your risk tolerance goes down, you just want to have less calculated bets because you have less, you don't have the context. But I think that you could continue that kind of, like the 20-mile march, as Jim Collins talks about it, if you're constantly looking at the information. So it doesn't matter where you're at in your own career or the business, that you can actually continue to make the right bets based on the information you're getting.
Absolutely. And sometimes the right bet is don't expand this year because there's something ominous on the horizon. And entrepreneurs, particularly in the first half of their careers, tend to think every time is the right time to go forward because they took that last hill and they're going to take this hill, right? But one of these days, the hill moves. And it doesn't work out so well for him.
I had this guy on the show, Mike McAllowitz, and he said after he sold his company, he thought he had the Midas touch, and then he realized that he had the touch of touch of death to every single investment that he made because it was the wrong hill, like you said.
The psychology involved in economics and even in running a business it is truly amazing, but it makes it so worthwhile. You talk about context. The fabric of what we have to contextualize is so multidimensional, Ryan. It's incredible. Like I noticed, I'm not even sure what day it is today, last week, that the U.S. government 10-year bond yield was higher than China's. That's not normal. That's not right. So that something's wrong out there in the marketplace. The bond market is trying to give us a message. If it lasts for, a month or something, it's going to mean something's gone wrong with the value of the U.S. dollar, right? And if that happens, that has implications for interest rates. It has implications for trade. It has implications for inflation.
Everything. Yeah.
And that down the road is going to impact businesses in ways that they wouldn't have seen coming. Because when I talk to business managers, owners, they'll say, well, the U.S. is always going to be the strongest. We're always going to be the best. The Chinese aren't transparent, et cetera. But right now, the bond market seems to be telling us that they're not in sync with what we think as U.S. business people. That's what I meant by that. That the multidimensional fabric really gets stretched pretty thin sometimes. But that remains part of okay, so if we see something else weird happening, well, I'll be able to tie it back to that data point and give it some context, give it some understanding, rather than it's just, where'd that come from?
Mm-hmm. Mm-hmm. Which, and I think the multidimensional, Brian, is a great adjective for it, because it's really like seeing the future in three-dimensional. So I think your point about the multidimensional and tying these variables together, that's what my hope is through these conversations and through these quarterly updates, that we can give that context to say, okay, how do we help everybody see a little bit clearer in three-dimensional going forward, so their bets can be more calculated, regardless of whether they're betting or pulling back. So I love the mission that we're on here. And you guys have, right before we get into some of the kind of current state of affairs, you guys have this 2030 depression you guys talk quite a bit about. So you want to kind of just give everybody some context on that, and then we can jump into some of the stuff that you guys are seeing?
Yeah, briefly, because I find if we spend too much time on it, people get focused on that, and they'll miss all the wealth-creating opportunities that still lie before us between now and then. So I think it's best to think about the 2030s as the realization that a lot of the trends that we have embarked upon are not sustainable. In April 2009, for instance, our national debt exceeded 80% of our nominal GDP. 800 years of economic history tells us that that's a tipping point that you don't easily survive. You have just embarked on a course that is unsustainable based on 800 years of history.
Mm-hmm.
Modern monetary theorists will tell you, well, we can get away with it because we're the United States of America, we're the best, we're the world's favorite reserve currency. But as we continue to pile on debt, why will the world just continue to assume that we are able or even willing to pay off this mountain of debt, that we can afford to do it? Well, they're going to continue to have faith in us if we start raising taxes enough to cover at least the interest payment on this debt, because it's just going to start compounding like crazy as interest rates go up. And at the same time, we have a demographic issue with the aging population just taking more and more resources out of the economy. And we have a government that seems more and more determined every year to take on a larger portion of the healthcare costs in this country, and transfer payments to other people that may or may not need the help. That's a different conversation. It's you reach a point where you can't write the check anymore. There's a reset button that has to be hit. Mm-hmm. And that's what the 2030s is. Our Vice President of Economics, Jackie Green, has a great way of framing it for people. The 2030s, the first half of that decade, will be like an economic forest fire. All right, and it's debt that lights that fire, and inflation is the match. What happens during a forest fire? All the dead wood on the ground gets consumed first, right? Mm-hmm. Those are the zombie companies that really shouldn't be.
What, they're not making any money.
Resources. Yeah, exactly.
Shocker.
And even some healthy trees get singed. They'll survive, but they carry the scars of that time. And the forest canopy, opens up, and now light is coming down where it never came before, and all of a sudden you start seeing green shoots where the dead wood was. Instead of the dead wood, you have these green shoots. That's what's going to happen in the 2030s. We got to get rid of some dead wood that sometimes is outdated technology, sometimes it's outdated ways of thinking. Mm-hmm. And it ties in very well with the demographics, because by 2036, half of us baby boomers are deceased. And your generation and even younger starts making the money shots and investing in these technologies that, quite frankly, my generation we don't understand. We don't. I couldn't explain the cloud to anybody. I know it's there. It's kind of magic. It's kind of cool. But I'm not ever going to get into a driverless car because I have an ex-wife. I just don't do those things. But
I got a buddy comment, because I got a Gen X buddy, Brian, that he goes, I'm not getting in a self-driving car until I don't have to reboot my phone once a week.
Yeah, exactly. Yeah.
Well, and I think it's and for some context too, Brian,
you're going to absorb that technology so much faster. I'm sorry, Brian, you go ahead.
Oh no, we had a little bit of lag. It's all good. And like you said, what I love about economics and macroeconomics, Brian, is the trends. You get to see the waves, like you're saying, and yet it's just another cycle of, hey, this next generation is coming up, but there's the opportunities along the way, like you said, so it's not all negative. Like,
That's it.
yeah, and I really appreciated your metaphor and the analogy that you gave, because it does set the stage. It's not doom and gloom, or not. And to kind of pull back on what you said at the very beginning, this is objective. You're looking at it as a machine. So it's not like you have a vested interest in saying that. It's more of just, here's how it works. The waves are coming, and just how do we then deal with it once we see them?
When we tell people that there's likely to be 20% unemployment, maybe even 25, I enjoy looking at their faces, reading their faces, because some of them go into like a catatonic shock, trying to absorb that. And every once in a while, you find somebody they light up their eyes and they say, well, that means 80% of the people are still working. They're my customers. I'm going to make sure those are my customers, not the 20%, but the 80%. And I said, you're an entrepreneur. Now you get it. Now you know why we talk about this stuff.
That's awesome.
There's always a way to make money.
I love it. I could keep going with stories, but so as we continue these conversations, we're going to start talking about the trends that you guys are seeing as your team is piling through data and everything like that. So, like, to say that there's lots of cross currents going on right now is just a flat understatement. I think, because every day I'm talking to people, they're concerned about interest rates, inflation, supply chains, labor, the war in Ukraine. I mean, like, so I don't even know. We don't want to overwhelm people. We want to give them some information that'll help them, see and read the news and have the conversations with more context. So how do you want to unpack just kind of what's going on right now, and then kind of set the foundation for the future conversations?
The news cycle and pundits most often have their own agenda, and it isn't to elucidate the future for you so you can plan. It's to get you to react for one reason or another, to follow their biases. Don't manage a business by headlines. Don't manage a business by the first paragraph of any news story, because that's not where the real news is. I just wrote our executive summary that'll be coming out on June 9th in our trends report. And, I bet you haven't heard the China leading indicator has reversed direction in the rates of change. I bet you haven't heard that single-family housing permits have reversed direction in the rates of change. Those are the green shoots that are already happening right now. Mm-hmm. Retail sales adjusted for inflation had an incredibly strong April. Bet you didn't hear that either. It's all about having the balance. Yes, the interest rates are going up. One of the things I do when I look at a company is I stop and figure out, are they interest rate sensitive? Some companies, they're not. Doesn't matter what interest rates are doing unless they're going out there and borrowing a lot of money. Right. So does that even matter to your business? If it doesn't, put it aside.
Forget about it.
All right. Inflation. Yeah. Inflation's going up. All right. Have you figured out how to raise prices? Better learn how to deal with that. And this isn't the first time we've had inflation, and inflation isn't going away. So instead of wringing your hands about it, understand that today's 10% rate of inflation will be tomorrow's 4% rate of inflation. That's the way it's going to go. It is logical. It is inevitable. It always goes that way. This is not going to be any exception. So don't worry about 10%. Figure out how you're going to live through 4%, which is a whole lot easier to do than 10%. Mm-hmm. So that's part of the context, right, that you were talking about. But people, even really smart entrepreneurs, tend to extrapolate recent events linearly into the future. And it never works that way.
I love it. Exclamation point. And it's very interesting, Brian, over the last, like I said, 3-4 years, as I've really become a junkie on this material, that I've honestly just felt a sense of peace because of what you were describing. And again, to kind of put a thread throughout future conversations that we'll be having is, I read over the last couple of years, Ray Dalio's Changing World Order, and then Paul Volcker's book, Changing Fortunes, and then Between Debt and the Devil. And it's just like different angles of thought. And like, I could go on and on, but like what it is, to your point, I can read the Wall Street Journal and go, doesn't matter, doesn't matter, doesn't matter, doesn't matter. Oh, that's interesting. And then you kind of can follow that just to get a little bit more clarity. But it just allows me to forget about a lot of stuff, to pay attention to the stuff that only matters, and which I think so many people get too paralyzed.
Yeah, absolutely. When you shut off the noise, life gets a little bit more high fidelity in terms of your focus and getting your business where you really want it to go. The cycle matters. We look at businesses that are $5 million a year in revenue, and we see the cycles. We look at businesses that are $5 billion, and we see the cycles. Timing is different. How fast you can make a change based on the cycle is obviously going to vary between those two extremes. There's only one company that immediately comes to mind that I personally said, I can't help you. And this company did nothing but sell frozen hamburger patties to McDonald's. And this is when McDonald's was just growing and growing. I said, you don't need me. You just got one customer. He's doing great. Go for it. Have a good time.
That's fantastic. Little bit of risk there, but you know what? Ride that coattail and use it to fund something else to diversify, maybe. But that's not what I do. I'm not a management consultant that says you really need to diversify. I'm here to forecast. That's all I do. So, when we think about, because you great comments about inflation, supply chain, is there certain data points that you like that we should be paying attention to as it relates to labor, inflation, the supply chain issues? I mean, where do people turn, or how do they start using, if they're going to start following you guys, how do we start using that information, and what should we be paying attention to?
We have free material available on our website, ITReconomics.com. They're called ITR Trends Talk. Trends Talk. They're free. We make sure that they don't last too long. I like 3 to 5 minutes. Some people go 7 minutes, but I find people's attention span wanders. But you can look up all these different topics there. You can also see our blogs. We're here to help people make really smart decisions. So I can't tell you that there's a list that I can give you on any of these. Obviously our subscribers know a whole lot more than non-subscribers do. But we're not trying to hide any of this stuff from people who are just in the weeds every day running their businesses. Go to our website. It's free, man. You can see the future first.
Take the curiosity.
That's our little tagline. See the future first. I
love it. And I think we'll wrap up on that note. And then the next quarter, as we continue to do these, we'll get a little bit more context. I want to start diving in more into the business cycles, and then layer the context that once we have that context, layer in some of the trends that you guys are seeing. And I'm going to continue to follow some of the material. And I'm just very excited because as we continue with you guys and then GF Data and then Butcher and Joseph, we're going to be able to go from like the macro to then understand a little bit more what's going on in the M&A marketplace, and then kind of on the street what's actually happening. So kind of from macro to micro over the course of an hour or so. Okay. And I'm just again so grateful that you guys decided to join up and do this with us.
Ryan, you're a pleasure to talk to. You're very aware. You're very smart, and you have a lot of the characteristics that we look for in terms of objectivity and a thirst for knowledge. So it's a pleasure talking with you.
I appreciate that, Brian. Objectivity is I like that adjective. I never would have thought that I would have been appreciative of that adjective, but it is something that is enjoyable, and I appreciate the conversations.
Okay, my pleasure.
Bob, welcome to the show.
Well, thank you very much, Ryan. Glad to join you, and glad GF Data can share some information with your group today.
I'm super excited because, a little bit of background. I saw, I think it was Graham speak at an AM and AA conference that was referred to me by our dear friend Ken Sangenario from the Value Opportunity Profile, a bunch of different connections here. But I was sitting there and I was in this group, and there was a lot of suits in that room in conference at one point. And I was like, you know what? Wow, there's a lot of deal flow going on, a lot of stuff happening here. And then Graham got up and spoke, and I was like, whoa, there's like a source of truth actually in the middle of all this. And I kept coming back to GF Data. And so I'd love for maybe just give a little bit of an overview of GF Data, where you guys came from and where you guys get your information, and then we'll jump into it.
Great. No, I appreciate that. And it's funny with the truth. One of our subscribers in St. Louis that has a small investment bank always put truth serum for the middle market. So we had labeled that as
Cool.
our motto for a while, and we've since moved on, but we like that title. Well, so what we do and why we're here, we started GF Data years ago, 2006, back when you were probably, playing Little League baseball. And
No baseball here, but I was definitely in high school. Oh, no, I was in college.
So the challenge, and it continues to be the challenge, is on lower middle market deals, and we term that businesses with enterprise value of 10 million to 250 million. Most of those deals are private seller to private buyer, and almost every deal has some form of confidentiality. Nobody wants anybody to know what they paid for a business, and nobody wants anyone to know what they got for their business, or their uncles, cousins, and such we'll be calling them. What we did is we worked with a security software group and created a utility so that we could get detailed information on completed deals from private equity groups, and I'll explain that in a minute, and let everybody maintain the anonymity they want and they need. And we've grown this till we have over 4,000 deals in our database, over 250 private equity groups that agree to participate and contribute information. And so, as you said, we believe, and our subscribers and so many others feel that this is the most on-target information in the lower middle market. There's a lot of other resources out there. What you find out is they're doing one of two things. They're either giving you Main Street deal information, which is fine if you have, 10 pizza shops or, some gas stations.
Dry cleaners. Yeah.
But if you've got, 50 employees, 2 million, 5 million, 10 million of EBITDA, and you're a mature, profitable business, you probably think your business is worth maybe twice what it really is worth. And that's not any fault of theirs, because the only information being reported is these public deals. Oh, yes, they also have a widget company that's sold for 12 times adjusted multiples, EBITDA multiples. And they forget to say at the end of the sentence that was a 25 million EBITDA company, not a $2.58 million. And so that's really, why this is so important. And, we think the most important value we bring to the market is managing seller expectations, because no one in the advisory world wants to say, your baby's not so hot, but they do want to say this is what market is. And, that's the biggest service. And then we get into, and I'm going to talk about a little further, leverage structure, leverage pricing, how that affects the market on a quarter-to-quarter, year-to-year basis, because this market has changed quite a bit. And when we get into the actual data, I'll be showing you that we're seeing the highest multiples of adjusted EBITDA for lower middle market businesses in the last 20 years, probably ever, but since we started collecting data in 2006. So pretty exciting times if you own a business and want to exit, but not as easy as just saying, oh, good, I can get 7 times adjusted EBITDA. There's a lot of things underneath that. So that's why we're here.
Well, and I think I'm very excited that I get to participate in this journey of bringing some of this information to people, because we could all pull up in CNBC and we can all see the public markets, what's going on. And then everybody goes, well, that doesn't translate to what I've got going on to the 50 employee company like you're talking about, Bob. And then I covered with Dr. Craig Everett in the Pepperdine study. We were talking about the intrinsic financial value, and then there's the market value, and there's sometimes a spread between the two, especially now with the multiples and the dry part or trying to find a home in these lower and middle market companies. And I think, like you said, the source of truth, hey, what's actually happening, and then why, versus the country club Vistage roundtable discussions of, oh, Bob got 25 times revenue, right? And how does that translate from your SaaS company doing 25 million in EBITDA to my steel manufacturer, steel fabrication business that's, doing 2 million in EBITDA? There's just no way for people to gauge that. So I'm very excited that you're here and you're willing to participate. And so what's the process of gathering the data, just for the listeners, so that they can understand, how are you guys gathering the data and what are you guys focusing on?
Sure. The big question is, why would these private equity groups give you information? Because private equity groups are private. That's half their name. And they don't want to share. They're scared. So again, we structured a secure utility that allows them to give us data. We promise complete anonymity to them. We know them. We're careful. We vet them. They're all regularly acquiring mature, profitable businesses. We have structures to avoid distressed deals, to avoid venture deals. But they need the data back. They have a lot of purposes that a business owner wouldn't have. Many of them have to mark their portfolio holdings, say what is the value today versus when they bought it, based on both market conditions, size, and other areas. They all have to go back to their investors. And that's always a big thing. You want to be able to tell your investors, I paid more than market. I paid less than market. But what is market? And that's why they really like to use our data. And then they have the same issue as the investment banks, advisory groups that are going out there. So much of the deal activity is proprietary deals where a business owner says, you know what, this green widget company of mine should go to Smith Widget. They'd be great. They'll get all these synergies, but how much does Smith Widget give me? And that's where now you have a market, and then you can add on all the synergies and the savings of a sales team consolidating, the savings of closing a plan or expanding a territory. But until you know what market is, that's what you need. And so that's why the private equity groups are willing to give us information. They just don't share otherwise.
And then what information are they giving you that then you aggregate?
Yeah, we developed a template. And one of the things you learn quickly in the data business, and we're more in the advisory business than the data business, but when we started out, we talked to a lot of good data folks. And one thing they told us is avoid burnout. Keep your template that they have to contribute information to 15, 20 minutes at most, because after that, you start to dilute the quality of data. So we designed it to come out of the deal book. Everything we do is based on completed deals. Everything's trailing 12 months to the end of the deal. But when these folks buy a business, at the end of the deal, they have a deal book that has everything in order. And so of the 25 data points we asked them to provide us, 23 are definitely in the deal book. And the other 2, they just flip a coin. Now, they have a little discretion.
And this is everything from how much equity versus how much debt.
Yeah, so we're asking
conditions.
them, and we give them tight definitions. So when we ask them what EBITDA was, we get what's known as adjusted EBITDA, normalized EBITDA. So a typical small business owner, when I say small, business owner that's doing $2 million of EBITDA, they'll pay themselves $900,000, $1 million a year. Does it make sense to them? But when the private equity buys the business and corrects executive compensation, it's probably $350 or $400 that CEO for a $5 million EBITDA company is going to make, maybe with bonus or whatever. But the point being is that's been adjusted. Same with the amount of working capital, how much excess cash needs to stay on hand. All those aspects that when a professional buyer looks at a business versus a seller saying, this is how I do, those have been corrected already. So it's all normalized EBITDA. We capture revenue growth, margins. We come up with the margins based on the revenue growth. If management's continuing post-transaction, because that's a big difference. People think they can hand over the keys, and they can, but most financial buyers are buying the management team. Same with the amount of rollover equity in a deal. So many of these private equity groups, when they talk to a business owner, and they say, do you want to be part of the business going forward? How much will you roll over from your proceeds into the new company? And the business owner says, I don't know, 5%. They say, that's a heck of a business you got, but probably isn't a good fit. They want to hear from business owners 20, 25, 30%, because that means to them, the business owner believes in the scalability of the business and believes in the business going forward. And so those type of questions are very simple, but really tell the truth to what is going on in a financial buy. We capture a lot of debt information, the amount of debt, senior debt, the sub-debt piece that's in there, the pricing of the debt, because that really affects what the private equity groups are able to pay, not what they're willing to pay, but what they're able to pay. So
I love that. You just hit.
They have a whole formula that I'm not going to go into, but they take the growth rate, the margin, and they extrapolate that out with how much debt they can take on, what the pricing of that debt is, the sub-debt to fill the void, And then the bottom line is they have to figure out a method that tells them they can return their investors 20%. They, of course, shoot for more. The reality is they're probably at this point in the marketplace getting 13 to 15%. And of course, if you add inflation, maybe they're back to 20%. So,
Bob, I just love it because I remember when I was at the conference and I was watching the panel with Graham speak, and I literally was like, holy shit, like we're actually talking about these companies like assets, right? Like it's everybody in there talking about the business, like growing a valuable piece of their investment, right? All the things that you just talked about is a mathematical equation to analyze a valuable asset and to get the 20% return like you're talking about. And it's so fascinating to me, Bob, because out of 300 episodes now, the amount of stories I've heard from entrepreneurs, and like you said, there's no foundation to stand on. It's like someone got all cash for, selling to a PE firm, no rollover, 120 million. Over here, someone had no cash down and it was a SaaS company. It's like, well, where's the rhyme or reason for any of this? And I think the takeaway that I want people to hear about what you just said is that there is actually a mathematical strategy that people are implementing that are professional buyers, and they have a formula, and you're talking about these 25 data points that matter to them. And that's the lens that they look through when they're looking at these companies. So even the people that have been on my show, they tell their story from the kind of the layman's business owner's terms, but what behind the scenes, everything you just discussed happened, whether they know it or not. And I think that's what I want to have people take out of that.
I think the other motto you can come up with or pass on to the people who are listening in is buyers are rational, sellers are emotional. And, a seller can tell a story all they want about if we had another branch in London or if we closed our, manufacturing facility in California, but they didn't do it. So now they're asking the buyer to take that on and say, oh, I'm going to buy this business because I know I can make extra money by closing something the previous owner didn't close. Well, why didn't they close it then? So, these fit all into the equation, and that's the rationality of the buyers. People ask us, why are we just taking information from buyers or private equity buyers as opposed to sellers or corporate buyers? And the two reasons, private equity buyers are consistent. They've all gone to the same MBA program. They judge everything very similarly. So we know what we're getting from them is consistent, and you might like it or not like it, but you know what it stands for. Like earnouts, which we'll get into. We don't have them include earnouts. To us, they're a what if, could have, should have number. To somebody who sold their business for 20 million and might get an additional 5 or 10 million if something happens, that earnout's real. They're saying I got 25 or 30 million, but it didn't happen, and it might. But so those type of things. That's what you said,
like the book at the closing, right? Like that's the earnout isn't captured at closing, and it's essentially just a bonus program of performance, right? So I mean,
in some cases, it's probably going to happen, but to prove it out, to bridge the difference between what the seller believes and the buyer believes, that's where the earnouts create. Everybody hates them because that means for the next 24, 36 months, whatever the length of the earnout choice is, you two are kind of competitors for do I want to give up more money and was it truly earned? But
I love
that's why everybody loves rollovers, hates earnouts. But the point being, to get back to your question, is that's why we stick with the financial buyers and the strategic buyers. They make sense, but you just don't know how much of the synergies are involved when a Smith Widget buys Green Widget company. You just don't know that. So that's why we try to avoid those.
I love it. So I know that we're going to continue to be doing these updates, and you've got some information on 2021, so we can kind of whet people's appetites. We don't need to overdo it right now, but we've got some 2021 information, as well as you've got some preliminary discussion points on 2022. It's kind of, we can take it however you want because we're just starting this. So feel free to just, I know we're going to be screen sharing, so that for the people listening in, we'll be discussing it while we're looking at it, and people that want to check out the YouTube video too, we've got that available.
Great. And you're seeing my screen now, I hope.
Yes, I am.
So this is just a quick recap of us. I'm going to go on to the first slide. So this is the broadest of data we show. We get very specific for our subscribers. put a little pitch in. I mean, we get down to a 6-digit NAICS industry code. So not just food manufacturing, not just animal slaughtering, but meats and carcasses from those animals. Very detailed.
Is that baloney? No.
Yeah, exactly. So, and we've got, just hundreds and thousands of categories. So we don't have them all, but we have a lot. But this is the broadest. This is the overview. And it does two things to get you started. First, we go from year to year. And we also obviously go quarter to quarter as we report. But it shows you the size premium, which it goes up or changes. But you can see from year to year, that size premium, the difference between a $10 to $25 million business. So we're really talking pretty much a 2 to 6 million EBITDA company or 2 to 5 million EBITDA company versus a 100 to 250 million business, which is probably a 10 million or 12 million to 20 million EBITDA company, and then the iterations in between. So,
well, and as I'm looking at this, Bob, well, you got what's super fascinating too about these four breakouts. So the 10 to 25 million, 25 to 50, 50 to 100, and 100 to 250. Like there's noticeable breakpoints where like once it's almost like Zillow where you go, I'm going to look for a $500,000 house and below, or it's almost like the search filter where you're going, there's a noticeable uptick as you get bigger.
Yeah, and a lot of it within the industry, we normally say $7 to $8 million of EBITDA is really the break point. We show everything by enterprise value, but what happens is a couple things. You got the girth or the big enough company that it could survive a lot of issues when you have 7 or 8 million of EBITDA, and then on top of that, the lenders, as we get into the leverage data, that's where they have more capability of lending. More debt allows people to pay up more with the whole formula and such. But, when we talk about market, 2021, despite everything that went on in the market, look at the bottom line and each of the categories. The overall average valuations went up. The bigger thing for us is the number of deals and at the bottom went up. It was a very good, busy year. And I'll kind of peek at 2022 since we've got the initial Q1 results in that we'll be publishing. I know this is not going to be aired for a while, but what we're seeing is the volume in the first quarter has dropped off. Q3 and Q4 of 2021 were incredibly busy quarter as far as deal volume. I think I have the quarter to quarter numbers, maybe not, and such. So people kind of left their pipeline aside. Businesses that would have gone through the process, because it takes anywhere from 3 months to a year once somebody's agreed, has the LOI agreement to get the deal done. Ideally quicker, but it's just the reality. So if something was, if there was a LOI agreed on in September of 2021, it didn't get any attention unless it was meant to get through the gates by the end of the year. So,
and some little anecdotal information is that the amount of people that were calling me, Bob, and then I was just lobbing over to investment bankers, like, I got to get the deal done. Taxes are going to go up. And it was just like this pure, like, I don't know what the interest rates and taxes and this and that. And the investment bankers were so busy. It was ridiculous. Like, so, I mean, I can only imagine.
People had pretty much felt that the interest rate thing was going to go away. But once mentally you commit to get the deal done, you want to get it done. It really ties you up, as you probably know from selling your business. You get into that, even though you try to stay professional and keep doing what you need to do to run a good business. It's very tricky that way. The next thing I wanted to kind of show you is the quality premium. This is something we do that nobody else does. And what we do internally is we tag businesses with better revenue growth and margins compared to the other businesses. Now, remember, all our deals are coming from financial sponsors. And to get a deal done with a financial sponsor, it's got to be a good business. So we're not talking about... Can you give
your definition of financial sponsor?
A financial sponsor is someone that is... Normally it's a private equity group. Sometimes it's a family office or another mechanism. But they're buying the business because they like the financials. The financials can support... They like the business too. But the financials on a standalone basis, it's not being bought to merge into a second business. Maybe down the road, but... the thought process is we like this business, we like its numbers, we can buy it, based on everything that we're seeing. It doesn't need synergistic savings to make it viable. So, these are all good businesses. And so we look at two things, the above average financials versus the other buyouts. And you can see how different that is. And that's different because people want to buffer themselves. If something should go wrong, if it doesn't have the growth and margins, the private equity groups, the last thing they want to do is a capital call.
Well, and I'm gonna read a couple. So like the above average financials in 2021 got a 7.9 average multiple, and the other buyouts got 6.1. I mean, that's a significant difference. I mean, oh my gosh.
This is across the board, all deals 10 million to 250, and we cut it in other charts. But for this purpose, yeah, it's a huge difference. So that's the biggest premium that we've seen. The more interesting note, though, was when we look at the bottom line where we talk about the incidence. And incidence means what percentage of the deals we saw fit that above average category. And historically, it's been 50 to 55% of the deals that get reported fit that. In 2021, it was 66%, by far the highest proportion we've seen. And that told us two things. First is kind of a nuance is that revenue growth went up in 2021 because so many businesses had flat years in 2020 as far as revenue. But what we always laugh about internally is the deal, we don't report on the deals that didn't get done. And this kind of goes back to, why we're going to see lower deal volume at the beginning of 2022, because the deals that weren't home runs, they weren't getting the attention of the lawyers, the quality of earnings folks, the due diligence folks, and of course the private equity groups. So they'll come to market later in the year, or they'll come to close later in the year, but they're probably just good businesses. They're not necessarily, excellent businesses. So that was kind of an interesting note, and that's one of the things our subscribers really track on a regular basis, how that changes the appetite. Oh, here's our quarterly numbers. So I probably should have showed this second, but you can see at the end of the year, Q3 and Q4, the average multiple for both of those quarters was 7.5 times. And if we look back, you see a series of 6.6, 6.8, 7, 7.1, much lower. So, a lot of momentum finishing the year. Sometimes when people rush to get deals done for tax purposes, multiples come down because, they're at the buyer's mercy. We didn't see that in 2021 at the end of the year. So very interesting. And our preliminary numbers on 2022, the average multiple is staying up, the ones that got done in Q1.
Well, and just for the listener, if you want to go back for a second, Bob, like just the listeners in, between 10 and 25, it's 6.3, 25 to 50, it's 6.9, 50 to 100, it's 8.5, and 100 to 250 is 9.2. So, I mean, you're talking a big break at each of those different areas. And I think, the blend comes to 7.5, but, just to constantly reiterate what we're always saying on the show, Bob, is it all depends on your business, how good it is, why you're getting that multiple. So you can hear the blend of the average of 7.5, but your business is a unique snowflake that someone's going to be placing a value on.
Yeah, and the thing to remember, we're not going to go through our specific database, but as we go through, if we'll use the widget company example again, if you have a $6 million green widget company and our average comes out to 6.9 times for that business, it does not mean your business is going to go for 6.9 times. It could go for 5.5, it could go for 8. But what we're pointing out is this is what market is. So where do you fit into the broader level of market, be it your margins, be it your defensible positions, the customer concentration, all those other aspects that fall in. But at least now you know what good businesses with the growth rates and margins that we show are on average going for, and you have a place to start from, a true benchmark.
I love it.
We get into the debt, and leverage is always tricky because isn't that the buyer's problem? And most of the people we're talking to today or talking with today are on the sell side of the mindset. And it's important to note how much debt is out there, how the debt markets are reacting. Recently, we had some interest rate hikes from the Fed, and people thought, "Oh, is that going to alter what private equity groups and other buyers are willing to pay because there's, it's so much debt driven. The answer from almost all the private equity groups we know is, for now, not really. The interest rates have been so low the past couple of years that the market can absorb a couple bumps. How much, that of course we'll see. But for the bumps that are ahead of us, people are pretty comfortable. Nobody wants to admit it because, buyers of business are always pushing for cheaper interest. But we look at the average debt to EBITDA load for all in on these deals, and the difference between a $10 to $25 million deal. And this is one of the highest numbers we've seen. The average was 3.3 times. So if you had a 5 million EBITDA business, you could get 16, you can get.
I was going to say, let's do it. 16.3. No, 16.9. We can do it.
Yeah. So 5 million EBITDA business probably sold for 30 million, and you could get, 16.5 million on average in total debt. So that kind of gives you a little run of the numbers. And most of the people, unfortunately, who are running good businesses have their numbers down. Whereas if you have a 10 million EBITDA business that sold for $100 million, the average being 4.2 times, $42 million could show up in debt on average again. And there's going to be lenders, non-regulated lenders that we compare to commercial banks, and there's other lending sources. But it's really important to track how much debt is being used, not what's available, but what's being used.
Especially if you're going to be rolling over 30% and then all of a sudden you're tripping debt covenants because they loaded it too much. I mean, it's something that you have to be aware of as you're rolling it back over. I mean, you're now a new investor in that asset. So, it's important to understand that.
No, it's funny. Good transition to my last slide, which is here we look at what's referenced as the equity stack. And the bottom, and I'm going to use the $10 to $25 million deals. So what does that look like on average for equity? So if it's a $10 million deal, 15.1% is rollover. That means $1.5 million essentially. The seller is saying, I want to own that NewCo. The next 34% is senior debt from a commercial lender, the bank. The next 16%, which is a little bit high, but these are smaller deals, is sub debt that fills the gap. And so, that is, I apologize, the 34%, I knew the numbers were off when I started, is the equity. So I'm putting out, private equity group is putting out $34 million of their own money, or of their LP's money probably. Then the next level is
the senior. Yep.
The sub debt, which is 16, $1.6 million. And then the final level up top, the light blue, that's the senior debt. So a commercial bank is lending $34.5 million into this deal. And, this will vary, but the reason I really like to show this slide is getting down to the bottom block of how much rollover equity is going into the deal. And, we started to talk about that. That is such a key aspect, measuring the seller's interest in the business going forward and the belief of the business going forward. So these are the type of things that we'll talk about, as we go through the year. And it really, will be interesting to see how much that changes on the equity stack. But right now, the people are asking me as we go around the country and speak, what's the prognosis for 2022? And we're fortunate enough to have enough investment bankers, private equity groups, and lenders at the table to kind of turn the question on them. And, we see...
Give us your data and we'll tell you.
Yeah, and I'm going to go back to just you and I to come off the slides. The concern, the amazing thing about this middle market is think about what we've gone through the last 2 years. And yet businesses are, everybody talks about all these things that could affect market. And, all these exogenous events. Somebody wrote to me from a very good quality firm and said, is it the war in Russia or China, in Ukraine that's causing these things? And the answer is, unfortunately, you would emotionally want to hear that, but the reality is leverage and logistics. That's what's causing that's the only thing that's causing a pause in this market right now. Not leverage, logistics and labor. Got my L's mixed up there, but
But
we had this
makes
one
sense.
roofing company at one of our roundtables, and he said, it's so hard to get shingles in. And then when we get the shingles in, we don't have anybody to put them in place. So
Yeah, good luck running your business.
yeah. So, they're keeping good margins. They're getting, price increases. But, that's the challenge of so many businesses across the board, be it healthcare, tech, labor and materials. And so that's, because you want your business to grow. And if you can't grow it because there's just not enough materials, that's what makes a private equity group hesitate.
So, Bob, I am so grateful and excited that you've been willing to participate and that we're going to keep doing this. I'm very intrigued, and what an interesting time to be able to start getting data distributed to the listeners where, things are going to be changing with the interest rates. And as we look at supply chains and like you said, like with labor, so we're going to be able to hopefully give some people some basic data points that they can kind of track and understand how to take action with their business, to understand where they're at, to give themselves a little bit more clarity on the marketplace. And I want you to be able to tell the listeners, like, where do they find GF data? Like what are, you mentioned subscriptions. So like, where can people find you and what's the best way to engage with you guys?
Well, the quick way, it's gfdata.com. My email and such is bw@gfdata.com, Bob Wegbright. Just send me a note or fill out our form and it'll get to me. Let me know that you saw us here, and we'll see if we can help you a little bit. The subscriptions include quarterly benchmark reports as well as access to the database. They vary depending on firm and such, but compared to most resources, we're considered quite cheap, so that's good. But of course, somebody has to write a check. Now, I always like the story. I'll give you one subscription story. I got a call from a guy in it's kind of Alabama, Virginia area, lower Virginia, Alabama, and said, a private equity group approached us for our business, and they were using your data to tell us what market is. So I wanted to know what it is, kind of like where you're. And so we talked, and we actually hit it off quite well. He ended up getting a subscription, didn't sell to that private equity group, hired an investment banker from a very reputable firm, probably bigger than I thought. I talked to him a year later. And I said, whatever happened? Did you sell the business? And he said, we sold it for exactly the number that the first group showed us from your data.
That's awesome.
Yeah.
Hopefully it wasn't worth more. No, I'm just kidding.
No,
awesome.
They did a thorough process, more than I thought they would do, actually.
That's fantastic. And that's what we want for everybody. So, Bob, I'm so grateful for you to participate and looking forward to the next round in the next quarter.
Terrific. Well, thank you.
Jeff, how are you, sir?
Doing well, Ryan. How are you today?
I'm doing great, and as I was just saying, I am unbelievably honored that you and your firm were willing to jump on to this quarterly economic and M&A update. And when I got to introduction to your firm from ITR, I was like, there's how you guys go about to the marketplace is, I think, very unique because of the different ways that you guys can essentially monetize your clients instead of just everything's one hammer and a nail. They hammer to the nail, and so. Before we jump into some of the topics that we're going to be talking about, like valuations, M&A activity, taxes, and just all the different deal structures out there that you guys see in real time, because we were kind of talking about bigger stuff on a couple of the other segments, I want you to just quickly give the audience a little bit of an overview of your firm, your background, and then we'll jump into it.
Sounds great. Well, thanks for having me today and looking forward to chatting with you a little bit more. So firm's called Butcher Joseph, and we are a investment banking and corporate financial advisory services firm primarily. We have a variety of different sort of what I would call lines of business that sort of fall underneath that more generic broad umbrella. Foundationally, our firm, started with a investment banking sort of platform, and that continues to be very much a core, focus of our organization today. In that platform and that practice, what we're largely doing is working with founder owners of businesses in the lower middle market, privately held businesses traditionally. And what we're doing in a lot of cases is we're helping that founder owner essentially navigate the sale of their company. Many times today, most folks are looking to, at some point in time, find some sort of liquidity event for their business, and there are a lot of different avenues that, that founder owner could pursue. Frequently, it might involve the sale of the business to a financial buyer, which could be something like a private equity firm or a family office. Other times, it might be to a strategic buyer, which could be a competitor in the same industry, or maybe an organization that is an operating company that's looking to diversify their business a little more and has identified this particular channel of interest, and our founder owner's business sort of fits that bill. But I think the most interesting and sort of unique thing about our firm is, whereas those two tend to be the most commonly known and really, I think, the sole avenues of pursuit for a lot of folks, there are other ways to sell your business aside from those types of buyers. And one of the areas that we have a real strong core competency in is the sale of the business to what's called an employee stock ownership plan, also known as an ESOP. Yeah. And
I see that big smile on your face, and the audience is going, I know Ryan likes this. And it just Jeff, it's so awesome because you just listed all the different options. It's not jamming someone down one avenue, which I just absolutely love.
Yeah, exactly. The idea that we had at our firm and continue to maintain, and that we're sort of premised on, is, let's provide a slate of options to these founder owners. Let's explain the pros and cons of each one of these different opportunities and channels to whom you could sell your organization, and let's find the one that makes the most sense and fits best for what the goals and objectives you have for your, not just for your liquidity event as as an owner, and obviously your family members on a go-forward basis, but also what that might mean for your employees. And I think a lot of founder owners, particularly in the last 10 years coming out of the recession, we're starting to pay a little bit more attention to what's going to happen to my employees after I leave in the sale of my company. And so something that allows for those employees to have a chance to participate economically in the success of the business on a go-forward basis through an employee stock ownership plan has become, I think, more and more prevalent. And certainly something that we think is a really interesting opportunity for a lot of business owners and a lot of companies on a go-forward basis because of the unique tax attributes that are specific to that ownership structure that just don't, exist with other buyers.
Right. And it's bipartisan, like the only thing in today's world that actually is, right?
Yeah, exactly. Yeah, that's true. Exactly. That's exactly a good point. I think on both sides of the aisle, this concept of, making sure there's more equality in wealth and distribution of wealth across a variety of, constituencies is obviously a core focus, and the employee stock ownership plan model sort of, is consistent with that mantra. So it's been a core focus of our firm for quite some time. And, as you might imagine, as we start to work with these businesses and helping them navigate the sale, particularly in the context of, the employee stock ownership plan, a big part of what we need to do in a lot of cases is go out and help companies raise financing to be able to finance these acquisitions, right? So we have a pretty robust capital markets group as well, where we'll, help source financing for companies to support ownership transition. But it also might just be to support, growth capital. If you as an organization want to go out and make an acquisition and you need money to do that, we work with a lot of companies in that context as well, or refinancing the balance sheet, or dividend recaps to shareholders is another common usage of capital. We have relationships throughout the more traditional banking markets, and as well as the non-traditional banking markets, and that can be debt financing that's at the most senior level or even at the most junior level, all throughout what we call the capital stack. So it's a big part of the transactional environment, of course, is finding the right financing and building a durable capital stack that helps support the business in all economic cycles. So we pay a lot of attention to that as we're structuring these transactions.
Which I'm super excited to dive into this. I'm going to explain why I'm excited based on what you just said. And then I wanted, before we dive into it, Jeff, maybe then you can give a little bit about your role. But before we do, Jeff, I think just to bring it home to the listeners, because we talked about, with ITR Economics, like what's happening in the macro level. And then we're talking to GF data about like, hey, what's happening is they're getting the PE firm information about deal structures. And then you guys are in the thick of it. You're seeing it, like you said, with all these different options. And then everybody, I think in the privately held space of entrepreneurship is like, what does it mean to me? Like, what am I going to do about this? And one thing that we continue to hammer home, Jeff, is grow a valuable business based on de-risking your cash flow, and you're going to have all the options that you want in front of you if you focus on growing the value of that. And then you could sit down in front of someone like yourself and say, based on the value that I have, like, what are my options and what does it mean to me, from like how much I get up front versus like how long does it take for me to get my money, like all the things that really, really matter to people. You're in the thick of it, saying, okay, with the all the things happening in the world right now, what does it mean based on the value of the business, based on the options that I want? And I just see you guys understanding how to communicate that. And I'm very excited to have you as part of these segments because of that. So with that being said, like, what's your role? How do you play in the firm? And then we can just jump right into it.
Yeah, absolutely. Well, I'm a managing director here at the firm, and so a big part of what I do is obviously engage with our clients and help them navigate, these types of decisions and these types of transactions, these processes. I also lead our firm's valuation and opinions practice. So, in that particular part of our firm, it's obviously determining the value of an organization. That's clearly one of the most critical sort of pieces of information for a lot of business owners to make a decision. And the unique thing about the ESOP too is that you not just have the founder owner of that company that's curious about his business, but when you sell your business to an ESOP, you're selling it to a trust that is obviously there for the benefit of your employees. And so there's generally an ESOP trustee who is responsible for being the fiduciary, looking out on behalf of those ESOP participants. Those ESOP trustees generally hire their own financial advisors and their own legal advisors. And so in the valuation and opinions practice, we take on that role as the ESOP trustee's financial advisor. So we're looking at it from the critical lens of the buy side as opposed to the sell side. And obviously helping the trustee in their capacity as fiduciary to make sure that the value that is ascribed to a business is fair, from the perspective of the participants who ultimately will be the ones that sort of own it on a go-forward basis.
Well, and I want to pull a thread right there too, Jeff, because when you say, I want to kind of bring some of that terminology home, where you said if it's fair for the trust and the employees, which really means is the valuation and how much money the senior lender is going to have that gives them up front, whether it's a third or a half, plus then their seller's note and the interest rate tied to it. You guys are making sure that all works based on the cash flow of the company, right? I mean, like, which then goes into, like, as we're going to about to dive into this, like, how does the interest rates and all the crap going on right now impact what we were just talking about?
Right. Yeah, exactly. There's a lot of moving variables to that equation for sure. And so, yeah, that's exactly right. We're very much involved in making sure that that the entire package is supporting, the company, the value, and the ability to finance, obviously, those debt obligations as they come due. The ESOP ownership structure inherently necessitates an annual valuation. So the participants know exactly what their economic participation in that organization is worth. Very much like you get a 401k statement in the mail, these ESOP participants get an ESOP statement in the mail. And so in that role as well, we'll do the valuations on an annual basis for the operation administration of the ESOP. So my role is multifaceted, as you might imagine, and just kind of depends on where we are as an organization in engaging, whether it's on the advisory side for an ESOP trustee or the advisory side for a company or a founder owner. I'm generally involved in working with those clients in these types of capacities.
And it's, again, so excited because your perspective is coming from different angles and how you're looking at the value and then the deal structures based on interest rates, deal activity, all that kind of stuff. And so it kind of leads us into one of the first of the four topics that we're going to start to as we do these quarterly updates. We're going to skim through some of these today, but we're going to hopefully by the time we're getting to this regular basis, regular routine, we'll be able to just kind of come in and just do these value shots. But when we're talking about is valuations and what's going on with valuations right now from, a couple of these different angles. I mean, there was a lot of activity over the last 12 to 24 months, man. So like, what's going on with activity and valuations?
Yeah, there's a lot, needless to say. And obviously, I think, a lot of people probably are very familiar, I think, just from, the business news channels with kind of what's been going on in the public markets, right? And obviously, as of late, we've seen a lot of volatility in the public markets. We've seen a lot of down days where valuations have come down, due to a variety of external forces and obviously the just general investor universe base of algorithm based traders and things of that nature. So I think if you look at the public markets, you probably are going to walk away thinking to yourself, well, valuations have come down. But there obviously is a very robust private market out there involving, as we already at the onset said, buyers of businesses that are companies that are not publicly traded. And that's a universe of, a different set of investors. And obviously, valuations tend to kind of, I would say, track the public markets, but really sort of in a slower fashion. And I think that, there's just obviously less volatility in the private markets because of this, there's so many other variables that impact the public markets that really have nothing to do with the underlying financial fundamentals of a business. Whereas in the private market space, obviously the underlying financial fundamentals of the business are sort of key, right? And those are the sort of things that these investors are focusing on, and so you're not going to see that same volatility, of course, in those spaces.
Yeah, and what I was going to ask, and sorry to interrupt you, was explaining maybe a little bit of what do you mean by fundamentals? Because I get you're right. Like the public markets have all the meme stocks and the whole world looking at them, that it's based on a lot of emotion. So then you're talking about the fundamentals because private markets naturally don't have that. So it's a lot of the fundamentals. In your mind, what is that?
Yeah, when I think of fundamentals, I'm thinking of the revenue and the earnings profile of these businesses, right?
Cash flow.
Cash flow, exactly.
What shocking, right?
Yeah, exactly. What's transpiring with cash flows, what's transpiring with margins. Clearly, the private market companies are not immune from many of the macroeconomic forces like inflation and the cost of raw materials going up, and the price of resin and the price of oil and the cost of labor. I mean, all these things are obviously something that you can't run from, regardless of whether you're public or private. But nevertheless, those cash flows become a point, certainly a point of emphasis, more so than that emotional trading that's driven by some, algorithmic program that's just hitting the sell button because there was a negative piece of news out there one day. And so in the private space, we tend to see a little bit more of a lagged effect, both to the upside and the downside. But I think generally what we're seeing is, at least now in the private markets, is a lot of the valuations are holding up pretty well. And I think that's just because there's still a lot of money that investors have that they're looking to spend, right? And private equity firms, they all have what we call dry powder. That's dollars that they need to find a home for, they need to invest, and finding good, high quality assets is still something they need to do. And so when companies come to market and they have the ability to demonstrate really good, strong cash flows, really strong market positions, good margins, the ability of management to maintain those margins in the face of an inflationary cost environment, it's generally going to captivate, those buyers in a really good fashion. And if you're running a process where you've got multiple buyers competing for you, like any other sort of auction dynamic, that tends to drive value up, and it tends to help preserve value. And so we are still seeing a lot of support for the valuations because of those types of dynamics with private equity firms all trying to put money to work in a high quality asset. And to your point earlier, Ryan, if you're a business owner and you're looking to position your company to go to market, and you can do those things early on, before you're ready to sell, you can sort of polish the rough edges. That's only going to make your company that much more valuable, number one, and attractive to the marketplace, number two.
And it's pulling on when you talk about the competition driving the value up, which makes sense when you're selling to a third party. We have this concept, Jeff, that we talk a lot about in our training, which is the intrinsic financial value based on the risk of the cash flow. Financial buyers like an ESOP, et cetera. So how are you seeing, because I was seeing for a year where the spread between the transaction value of a strategic buyer was so much higher. There's people like ESOP. They got an out of the blue offer from a private equity from PE firm. It's you change your tune pretty fast. So are you seeing that spread of the financial value compared to a strategic value starting to come a little bit closer? How are you seeing how the financial value based on their cash flow would be impacted based on some of the stuff we're seeing today?
Yeah, I think we'll probably start to see that spread compress a little bit, for sure, just because I think, there's inherently, this dynamic where kind of where we are today in the macroeconomic environment, and again, inflation and sort of the uncertainties around, a potential recession on the horizon. There's some, I think, a little bit more cautiousness built into those financial buyers than maybe they may have exhibited before. And so I think for that reason, they're using it as an opportunity to kind of recalibrate what they think they'd be willing to pay for this business. I think the rising interest rate environment obviously makes the cost of financing a little more expensive. And so, it's really just sort of an algebraic formula, right? I mean, cash flows are a certain amount, and you have fixed charges that you have to, cover. And so, if the cost of those fixed charges goes up, but the cash flows remain static, then, that lever suggests that you've got to probably have a little less debt in the structure, which either means you pay less or you come out of pocket more with equity. And generally, in order for private equity to be able to generate the types of return profile that they target, it usually doesn't promote coming out of pocket with more equity. It generally means you come down on the debt a little bit, which obviously might impact the value. So I think as those spreads compress between the difference in prices, it'll allow the ESOP structure to continue to maintain and number one, relevance, but also number two, perhaps be a little bit more competitive, because private equity buyers, I think, are going to be in a similar position in terms of leveraging. Inherently those are leveraged buyouts, as is an ESOP transaction. So those dynamics, without coming out of pocket and equity, mean the ESOP will be more competitive.
So, and are you seeing, because with the dry powder, I don't know if it's still around the 2 trillion. I hear everywhere between 1.5 and 3 trillion of the dry powder in these coffers that haven't been spent, and it's their fiduciary mandate to go buy something and give a return. And so if they can't find something, they're going to continue to outbid each other. So I don't know if you're going to see the really good disciplined PE firms continue to rise to the top. I mean, how are you seeing that? Because you said, we had all these cross currents, macro or micro going on, and then the interest rates and all these things. But then that doesn't change the fact that these people have to buy something, grow it, and sell it.
That's right. And if they don't go out and buy something, then what that means is at some point in time, they have to give that money back to the limited partners that gave them the money to begin with. And so obviously that they don't want to do that, and that's not necessarily good for their investment track record. So yeah, they want to find a home and for that money, and I think they want to put it to work. And so that is obviously going to continue to be a need, and will, I think, continue to support activity in the marketplace, regardless of where valuations go, and regardless of where the cost of financing goes. Right? I think the nice thing here, and the difference here compared to the financial crisis, is in the financial crisis, obviously activity sort of stopped in its tracks cold turkey because the financing market sort of dried up. Right? There just wasn't any ability to finance a transaction, amongst a variety of other things. Here today, even if I think things change and we start to move toward a more recessionary environment, I think there's still going to be a lot of activity. We're still seeing a very robust deal market. There's still buyers that need to put that capital to work. They want to put that capital to work for a variety of reasons if you're a financial buyer, but also the strategic buyers. I think, we're seeing more and more activity out of strategic buyers who they themselves have money to spend and are looking to either grow organically or inorganically. And they face themselves with this investment decision. If I want to do something and move into a new market, do I build it over time, or do I buy it today and be in there immediately? And I think they're realizing themselves that it may be a little faster to buy versus build. And so we're seeing them being continue to be pretty active in today's market.
Well, and it's interesting on the strategic buyers that you're just alluding to too, that I don't know if you're seeing this, but if we go into actually some sort of stagflation, I can imagine where there's people where acquisition is one of their primary growth drivers, and especially they got more cost synergies for the back office where they can afford to potentially outbid the private equity firms. I don't know if you're seeing some of those dynamics maybe kind of shift around.
Yep, no, absolutely. I think that's exactly right. I think that is tending to be more of a strategic point of focus for the strategic buyers, is to be more active in driving value through acquisitions. I think many companies, 10, 15 years ago, they may have said that acquisitions were a part of their growth strategy, but they may have only done one acquisition in 5 or 6 years. Now they may have more of a targeted mandate from their boards. Hey, let's go out and let's do one a year, right? Even if it's small tuck-in, let's go out and do that because we need to grow our business and we can generate more, I think, value for our shareholders through some of the cost synergies that exist by bolting together two organizations that, again, financial sponsors don't necessarily always enjoy to the same extent.
So then when you think about, because we've this has been, I love just, I could go on and on for days about this stuff, but when you think about the activity that we're talking about and the trends, but then there's the kind of the guts of it of like, hey, there's the debt and equity structures and the taxes, which really come down to like the mechanics of how these deals are getting done. What are you seeing that's happening right now that's kind of getting, are you seeing trends of people starting to think differently of how much debt and equity versus like what are they expecting for taxes and how that's impacting their decisions?
Yeah, absolutely. I think people are thinking about that a little bit differently. I know, 12 months ago, there was obviously a lot of discussion around changes to the corporate tax rates. You saw it every day, and there was I think a year ago or so, high probability that we were going to see an increase in corporate tax rates. Obviously, didn't come to fruition. It's never off, obviously, the radar. I think it depends on which administration is in office and kind of what their tax policies are. But I think, companies are certainly thinking about the tax, potential tax changes, because again, that would represent cash flow leakage out of the business, in addition to, your fixed charges to cover, principal and interest payments on your financing. So I think that goes into this idea of, again, just sort of being, a little smart about the structure that you use at the onset to purchase a business, how much leverage you place on an organization, knowing some of these changes could be on the horizon at some point in time, and making sure that you've built a capital stack that I think is more durable and able for the company to support in a variety of macroeconomic environments, not just in the good times, but also if maybe there's a down cycle in say a 12 or 18 month period. Let's test to make sure that our organization can still afford to finance these things in the event something changes to the downside, so that we still have the ability to operate our business the way we want. We still have the ability to finance all the organic initiatives that we have strategically that we want to deliver on, and we don't have to do something rash like cut your employee base to the bone, which are very, very difficult decisions folks don't like to do, number one, but also sometimes, particularly in a tight labor market, you hate to let go of talent knowing that this is a short-term cycle.
Right.
And if it comes back, we need to have that talent still here,
right,
because it'll be hard to replace them.
Yep.
And so what that'll do is have some short-term pressure on margins, and you just have to be mindful of that as you're placing debt, on the balance sheet.
Well, and I think what's going to be interesting as we continue these discussions is, when you're talking about the durability, and I'm just helping kind of continue to translate things, is like how much equity versus debt. I talked to this one gentleman, Jeff, using the SBA loan to leverage, do a leverage buyout, and like he's all of a sudden he's like, no inventory. Now I got $500,000. Now I've got like labor increases and I'm paying, increase in tax. And he's like, all of a sudden the whole equation just got flipped on its head. To your point, like he can't. It's harder to go through these choppy waves, and it'll be interesting to follow how people are structuring these, like how much debt versus equity. And that'll be super fun about as GF data gives us some of those guiding data points is, I also like why ESOPs continue to be more interesting, because doing an internal transfer, you're paying your taxes, paying the debt, dealing with inflation, dealing with labor. It's like all of a sudden you don't pay any taxes. Like that kind of is pretty appealing.
Yeah, no, exactly. I mean, that's exactly right. I mentioned it at the onset here. That's one of the unique attributes to the ESOP structure is that, there's two sort of unique attributes from a tax perspective. Number one is the ability for the founder owner to defer, capital gains on the sale of the business, and defer that for quite some time. And there's some strategies around, extending that deferral period even quite a bit longer. But then it's at the corporate level where, an ESOP as an entity is a tax exempt entity. And so any portion of your business that's owned by an ESOP is exempt from, federal taxes. And so, the coup de grace is you have the entire business owned by the ESOP. And now you've just put your organization in a position where you've got, tax deferral on all of your earnings. So as you might imagine, that gives you that much more of a cushion to support leverage on the balance sheet, right? Because any capital that otherwise would have been sent out the door, to cover a tax bill can now be retained in the organization, which can be used to delever the balance sheet. And obviously also at some point can be used to finance organic, strategic initiatives. Could be acquisitions, could be purchase of machinery, could be the opening of a new office.
Mm-hmm.
So, putting what otherwise would have been unproductive capital that left your business to go to the government to pay your tax bill to more productive uses, which drive shareholder value, allows you to grow your organization, be more productive, and obviously, that just makes the organization that much stronger.
Jeff,
relative to competitors.
I absolutely love it, man. I could keep going, but I want to make sure that we're tight and we're going to be able to combine all these different segments. What's the best place to learn more about you guys? And then again, we'll be doing this once a quarter. Most likely, we're going to kind of get into that cadence. So where can everybody follow you in between those calls?
Yeah, we are obviously a firm, as I mentioned, called Butcher Joseph, and you can check out our website, www.butcherjoseph.com. We're also on social media, and folks are welcome to follow us there. We do update that on a regular basis. So we hope everybody has a chance when they're free time to check us out. I think we've got a lot of good information, that you'll find on there, including some white papers and examples that I think kind of can give folks a lot of good insight as to the options that exist and who we are.
Jeff, thank you so much, and looking forward to next time.
Likewise. Thanks, Ryan. Thanks for having me.